In prior videos, we analyzed the business transactions of Eli's Consulting using the accounting equation and T accounts. These tools helped us visualize how individual transactions affect assets, liabilities, owner's equity, revenues, and expenses in a manual accounting environment. Now we're ready to move to the next step in the accounting process, recording transactions in the general journal. In this video, we'll learn how accountants use journal entries to record business activities using debits and credits while continuing our work with Eli's Consulting Services. Recording or journalizing business transactions in the general journal is step 2 of the 9-step accounting cycle. The general journal, where all business transactions are written down, is basically a chronological record of a company's business transactions and is an important link between the transaction analysis and the preparation and analysis of financial statements. The general journal is kind of like a business diary where accountants write down the business transactions that will be permanently posted to the general ledger, the foundation for all financial statements. The format of the general journal can differ from company to company, but the basic layout consists of the date, the description, which contains the account name, the posting reference, and the debit and credit columns. In addition, the accountant also writes down a brief description of the business transaction. Many companies, especially large ones, also add additional columns to the general ledger, like, for instance, codes for cost centers, legal entities, and projects. In this class, you're learning about the manual accounting environment, but in most companies, even small ones, journal entries are recorded in Excel templates and then uploaded or imported into the accounting software. The journal entry is then routed to an approver who posts the entry to the general ledger. We'll be doing that step manually so that you can understand what the accounting software will be doing for you. There are prerequisites for journalizing the business transactions of the business. First, you analyze the business transactions with the help of 2 tools that we talked about, the accounting equation and the T accounts. That's helpful because you're just getting started. Later, as an accountant, you would likely only use these tools for very complicated accounting transactions because you will quickly understand how repetitive some transactions are, and you won't even need to think about what accounts to debit or credit. But it will take a little while before you get to that point, and that is why it's so important and an important practice to first analyze the transaction. You do that by using the process we learned about in prior videos, by first determining what accounts increased or decreased, then identifying the account types for the accounts, and after that using the dealer mnemonic to find the debits and credits. And you also need to check the supporting documentation. Your reputation as an accountant is on the line when you record transactions without the correct supporting documentation or backup. I can't emphasize that enough. You have to have the right documentation before any transaction is recorded. Let's say you've done all that. Then the next step is to obtain a general journal template or form. And in most businesses, accountants use Excel templates. You'd enter the date in the date column, like in this example, January 2nd, the account name of the account you want to debit. Here it is the equipment account, followed by entering the debit amount into the debit column, in this example, $1,500. On the second line, you'd indent slightly and enter the account name of the credit transaction into the description column, and then enter the credit amount into the credit column. And here it's cash, the cash account, and a $1,500 credit. And finally, enter a short but concise description on the third line into the description column. In this example, it is purchase of equipment, ABC office supplies, invoice 212. It's really important that you remember that every transaction has to have at least two parts, at least one debit and one credit, and the total debit amounts must equal the total credit amounts. Let's practice this concept with the help of Eli's consulting services. For the first transaction, Trade and Eli obtained the funds to start the business by withdrawing $100,000 from his personal savings account. Now, before accountants record an entry in the general journal, they analyze the transaction and examine the supporting documentation. The supporting documentation for the $100,000 contribution is a memorandum from Trade and Eli to Sergio Sanchez. Additional documentation might be the deposit into the business's bank account and legal documentation that shows Trade and Eli gave Eli's Consulting $100,000. Accountants care about the supporting documentation and the audit trail, which is a chain of reference that makes it possible to trace information, locate errors, and prevent fraud. The audit trail provides a means of checking the journal entry against the original data on the documents. Documentation is critical. In addition, the external auditors will want to see the supporting documentation at year end as well. However, sometimes the supporting documentation is confidential. For example, severance amounts when there are company layoffs. In those cases, the journal entry will reference the person or department that can provide documentation upon request. Now, when we previously analyzed this transaction with the help of the accounting equation and the T accounts, we determined that cash increased, cash is an asset, and assets increase with debit. So we need to debit the cash account. We also said that money owed to the owner increased. Monies owed to the owner as part of owner's equity, and owner's equity increases with credits. So we credit capital, a special owner's equity account that is used for the owner's contribution to the company. And we're now ready to record the journal entry. To record the business transaction, we write the date into the date column, the account cash into the description column, and $100,000 into the debit column. We indent slightly on the next line, write Trade and Eli Capital in the description column and $100,000 into the credit column. And in addition, we'll add a short description on the third line. In transaction number 2, on November 7th, Eli's Consulting Services issued check 1001 for $5,000 to purchase a computer and other equipment. We can see the journal entry documentation here, but in a real company, the support would not be sufficient because it doesn't provide the details of the purchase, model numbers, specs, etc., and evidence that Eli's Consulting paid the information technology store. This document actually looks like a check stub from a checkbook. The accountant's job is that of the guardian of the general ledger, the place where all general journals are permanently saved. And the general ledger is the foundation for the financial statements. It is definitely not an understatement to say that the basis for all financial statements begins with the accountant's general journal and the supporting documentation. The necessary documentation in this case should be a copy of the invoice from the information technology store. The invoice should detail the items that were purchased and should show Eli's Consulting Services as the purchaser. Accountants are responsible for verifying proper documentation before recording any entries. When we previously analyzed this business transaction with the help of the accounting equation and the T accounts, we determined that equipment increased, equipment is an asset, and assets increase with debits. So we need to debit the equipment account. We also said that cash decreased, cash is an asset, and assets decrease with credits. So we credit cash. And we are now ready to record the journal entry. To record the business transaction, we write the date into the date column, the account equipment into the description column, and $5,000 into the debit column. We indent slightly and write cash in the description column and $5,000 into the credit column, and then add a description like in this case, purchase equipment check 1001, once the proper documentation has been received. In transaction number 3, on November 10th, Eli's Consulting Services purchased office equipment on account for $6,000, and we have the invoice here from Office Plus. The invoice shows an invoice number, date, order number, shipping and payment terms, the name of the buyer, and item details for what was purchased. This invoice shows the right level of support. Did you know that many businesses do not record assets for equipment and supplies that cost less than a certain amount, like, for instance, calculators? The threshold depends on the size of the business, and the materiality threshold differs from company to company, but the larger the business, the larger the threshold. The accountant is responsible for the accuracy of the invoice and the payment terms, as well as the proper purchase order number. In addition, the accountant needs to ensure that the correct sales tax is calculated. So if the information is incorrect, it needs to be revised. When we previously analyzed this business transaction with the help of the accounting equation and the T accounts, we determined that equipment increased, equipment is an asset, and assets increase with debits. So we need to debit the equipment account. We also said that accounts payable increased. Accounts payable are a liability, and when liabilities increase, they increase with credits. So we credit accounts payable. And we're now ready to record the journal entry. To record this business transaction, we write the date into the date column, the account equipment into the description column, and $6,000 into the debit column. We indent slightly on the next line and write accounts payable in the description column and $6,000 into the credit column. Then again, on the third line, we write a short description that summarizes the transaction. For transaction number 4, on November 28th, Eli's Consulting Services purchased supplies for $1,500 with check 1002. Again, for this receipt, this is not proper documentation. We don't have an invoice. In fact, we don't even know if supplies were purchased. We also don't have a copy of the check. This was not past an audit, and honestly, I would be concerned if a business owner provided this as a receipt. Now, when we previously analyzed this business transaction with the help of the accounting equation and the T accounts, we determined that supplies increase, supplies are an asset, and assets increase with debits. So we need to debit the supplies account. We also said that cash decreased, cash is an asset, and assets decrease with credits. So we credit cash, and let's now record the journal entry. To record this business transaction, we write the date into the date column, the account supplies into the description column, and $1,500 into the debit column. We indent slightly on the next line, write cash in the description column, and $1,500 in the credit column. For our 5th transaction, Eli's Consulting Services paid Office Plus $2,500 in partial payment of invoice 2223 with check 1003. In this case, we have the original invoice from Office Plus for $6,000 as support, but we would also need a copy of the check, or the Zelle or Venmo payment record would be good additional support. We previously analyzed this business transaction and said that accounts payable decreased, and because Eli's Consulting now owes less money to Office Plus. Accounts payable are a liability, and according to the dealer mnemonic, liabilities decrease with debits, so we debit accounts payable. We also said that the cash account decreased. Cash is an asset, and assets decrease with credit, so a credit to the cash account. To record this business transaction, we write the date into the date column, the accounts payable into the description column, and $2,500 into the debit column. We indent slightly on the next line, write cash into the description column and $2,500 into the credit column. And on the third line, we write paid on account, Office Plus, invoice 2223, check 1003. Next, for our sixth transaction, Eli's Consulting Services wrote check 1004 for $8,000 to prepay rent for December and January. Again, this is not proper documentation. In this case, I would like to see the rental agreement and a copy of the check or other payment remittance. We previously analyzed this business transaction, said that prepaid rent increased. Prepaid rent is considered an asset, and according to the dealer mnemonic, assets increase with debits. So we debit prepaid expenses. We also said that the cash account decreased because Eli's Consulting issued check 1004. Cash decreased, cash is an asset, and assets decrease with credits. So a credit to the cash account. To record this business transaction, we write the date into the date column, prepaid rent in the description column, and $8,000 into the debit column. We indent slightly on the next line, write cash in the description column, and $8,000 in the credit column. On the third line, we write paid December and January rent in advance, check 1004. For the seventh transaction of this new business, Eli's Consulting earned a total of $36,000 in revenue from clients who paid cash for accounting and bookkeeping services. Typically, for this type of transaction, we would have the sales invoice to the customer and a cash receipt as documentation. For this transaction, cash increased. Cash is an asset, and assets increase with debits, so we debit cash. For part 2 of our transaction, we can see that fees income increased. Fees income is part of the revenue category, and revenue increase with credit, so we credit fees income. To journalize this transaction, we write the date into the date column and then debit cash and credit fees income for $36,000. In the eighth business transaction, Eli's Consulting earned $11,000 of revenue from charge account clients. Again, for this type of transaction, we would like to have the sales invoice to the customer, and the invoice should show the payment terms, such as net 30 days or net 60 days. For this transaction, we previously identified that accounts receivable increased and that this type of account is an asset. And assets increase with debit, so we debit accounts receivable. Just like in our last transaction, fees income increased. Fees income is part of the revenue category, and revenue increase with credits, so we credit fees income. And to journalize this transaction, we write the date into the date column, and we debit accounts receivable and credit fees income for $11,000. In the ninth transaction, we record the customer payment when Eli's Consulting received $6,000 on account from clients who owed money for services previously billed. For this transaction, cash increased. Cash is an asset, and assets increase with debits, so we debit cash. In addition, money owed by customers, the accounts receivable decreased, and this type of account is an asset. Assets increase with debits, but in this case, accounts receivable decreased, and the dealer mnemonic is telling us that assets decrease with credits, so we credit accounts receivable. To journalize this transaction, we write the date into the date column and debit cash and credit accounts receivable for $6,000. For the 10th transaction, we're going to record the salaries that Eli's Consulting paid for the accounting clerk and Sergio Sanchez. This transaction, the expenses of the business increased. Expenses increase with debits, so we debit salaries expense. The cash of the business decreased. Cash is an asset, and assets decrease with credits. so we credit cash. To journalize this transaction, we write the date into the date column and debit seller's expense and credit cash for $8,000. The 11th transaction is very similar to the prior one. Eli's Consulting issued a check for $650 to pay the utility expenses. In this case, just like the prior transaction, expenses increased by $650 and cash decreased by $650. Expenses increase with debit, so we debit utility expenses, and cash is an asset, and decreases with credits, so we credit cash. To journalize this transaction, we write the date into the date column and then debit utility expenses, credit cash for $650. All right, we made it to our last transaction where Eli withdrew $5,000 in cash for personal expenses. Money taken by the owner increased, which is categorized as drawing, and drawings increase with debits. That means that we debit the drawing account. The cash of the business decreased. Cash is an asset, and assets decrease with credit, so we need to credit cash. To record this last transaction in the general journal, we write the date into the date column, and we debit Trade and Eli drawing and credit cash for $5,000. In this video, you learned how accountants move from analyzing business transactions to formally recording them in the general journal using debits and credits. You also saw how the accounting equation, T accounts, and the dealer mnemonic work together to help accountants determine the correct journal entry for each business transaction. Most importantly, you learned that accounting is much more than simply entering numbers into a system. Accountants carefully analyze transactions, verify supporting documentation, and maintain an accurate audit trail to ensure the reliability of the financial records and financial statements. Now, at first, journal entries, debits, and credits may feel repetitive and tedious or even overwhelming. But with practice, the process becomes much more natural. And the more transactions you analyze and record, the more confident you will become in understanding how the accounting system works behind the scenes. In future videos, we'll continue building on these concepts as we move further through the accounting cycle and learn how information flows from the general journal into the general ledger and ultimately into the financial statements.